Welcome to the Cambridge Tech Podcast, talking all things technology from the heart of the UK's tech capital. Here are your hosts, Faye Holland and James Parton.
I'm Faye.
And I'm James. So, I'm back. I didn't do news last time. So,
No.
How has your week been?
We missed you.
Yeah, I missed the big opportunity to big up Bedford as well.
I know. Well, why don't do that now? Do
Well
that
done,
right
Bedford,
now.
for getting Universal Studios. I'm not checking how much I can Airbnb my house for, honest, during the summer season.
You've got a few years to work that one out, right?
Yeah, a few years, yeah.
Yeah, very good.
So, yeah, what have you been up to?
Well, last week was a typical week, I think. I did a very Faye thing and took a brand that I kind of didn't really like very much and gave it a little bit of a refresh, and the client was very happy with it. So that's always nice. And then it was a long weekend, wasn't it? So to be honest, I'm kind of now wondering why we don't just do 4-day weeks.
Yeah, there's a book on that, isn't there?
There is. I mean, I think there's a whole movement on
Yeah.
that. I'm not quite sure I'd get away with it, but
No.
it's a good idea.
You're doing more like 7-day weeks, aren't you? But
No, I'm not. And don't say that to my husband
No.
either.
Well, he doesn't
will
listen, don't worry.
divorce me. Okay, thanks. Anyway, right. So obviously enough about me. James, do tell me about your week then.
Yeah, just a standard week. Lots of great meetings. Oh, we've got a new receptionist at the Bradfield Centre. So we've got Bo here now. So if you're coming in, say hi to Bo. So she's just going through our onboarding process. I've also been out and about, visited our Chelmsford office and saw the 2 Ellies there, which were lovely. So thank you for your hospitality. Yeah, that's kind of my week, really.
Yeah, well, that's what happens when it's a 4-day week.
Yeah, exactly.
it?
Yeah, enjoyed the long weekend as well.
But thankfully there's some news.
There is some news, yeah. Do you want to kick us off?
Why not? So first piece of news is from Nyobolt, the Cambridge-based pioneer of high-power, ultra-fast charging technologies, who have secured $150 million in contracts plus $30 million in investment from international backers. The investment has come from ET Captial Latitude, who's the sister fund of Local Globe, Scania Invest in Sweden, and Takasogo Industry in Japan. The funding will fuel Nyobolt's technology development and market expansion, including providing battery technology for power-hungry data centres. So just a bit of background on Nyobolt. They were the first company to successfully charge an EV battery to 80% in under 5 minutes. Its Cambridge University-born technology offers high power density and supercharging without degradation. Shai, the co-founder and CEO, said, "The world is experiencing unprecedented demand for power, not only to decarbonise heavy industries, but to provide enough resources to handle the surge in AI infrastructure. The energy status quo can't and shouldn't sustain these demands, and our vertically integrated technology is already positively impacting customers, enabling them to experience stable, fast-charge solutions when they need them the most." And he finished, "I'm delighted to have the confidence of our customers and investors as we strengthen our mission to push the boundaries of ultra-high power solutions."
That was a long one. You did well there.
That was really long. Did you give me that by
I did
any
give you
chance?
that. Yeah, I'm sorry about that. Yeah.
I'm just having a cup of tea while you do the next one.
So we talk a lot about the increasing blurring of the lines between the tech and the life science clusters in Cambridge, and our next story is a clear demonstration of that. Arm CEO Rene Haas has been named as a new non-executive director at AstraZeneca. Michel Demar, who's the chair of AstraZeneca, said Rene brings deep and broad knowledge of technology, including data science, computing and AI, from his numerous years' experience in the microprocessor, semiconductor and software engineering industries, and experience of leading a large Cambridge UK-based technology company. Rene joined ARM in October 2013 as Vice President of Strategic Alliances and was appointed Chief Executive Officer and to the board in February 2022. In September 23, he led ARM's return to the public markets with the most valuable IPO of the year, which we covered extensively. Go to our show notes and catch up with our ARM coverage by clicking the ARM tag or by searching.
And the third piece of news today is another battery tech story. And I'm taking another huge breath because this one looks like a long paragraph too. Leading energy supplier E.ON and Super Dielectrics, a Cambridge-based energy storage technology company, are collaborating to promote and advance a UK-developed battery solution ultimately intended to give millions of homes access to safer, cheaper and cleaner power. There is a shared vision to develop the revolutionary polymer-based storage technology, the main component of which is a membrane similar to contact lens materials, meaning that they are not only more affordable but also safer and more environmentally friendly. The technology is aimed at giving customers more control of their energy use at home, ultimately lowering their electricity bills and helping to reduce fuel poverty in the UK. From its early trials, Super Dielectrics estimates its technology could save the UK consumers up to 85% on their domestic energy bills while substantially reducing carbon emissions. And I think everyone would be happy with 85% less energy bills.
Absolutely. Okay, so moving on to today's episode, we have Martin Rigby with us from ET Captial. We covered the new Cambridge Venture Index Fund a few weeks ago in the news when it was first announced, so it's lovely to have Martin with us to tell us more.
Martin, it's great to have you with us today. I can't believe it's pretty much 12 months ago that we said we were going to get you to come on the podcast to talk about your research that you'd presented at Cambridge Wide Open Day. But we've got even more things to talk to you about today.
That's it, Faye. That was a presentation called Can Venture Capitalists Pick Winners? And we'd done a whole load of research based on data that we got from Giorgio Caselli and Andy Kosh at the Judge Business School, Centre for Business Research, which we chewed and analysed and rechewed and got it to spit out, which shows that actually if you took a diversified investment approach and invested in most tech deals in Cambridge since the mid-1990s, in fact, if you could invest in all, then you would have a strong return. A stock market beating return, which everybody said we shouldn't measure it against the FTSE 100, but we did. Next time we'll be measured against the FTSE 250. And that was the germ of what we were trying to do. And we ended up not just crunching the returns, but also synthesizing what would have happened if there'd been a series of 5-year funds in the period from the mid-90s through to 2014. All of those synthetic funds would have returned capital, strongly returned capital apart from 2004, which, if you recall, was the fund which was in the aftermath of the dot-com crunch.
That is a great tease for what we're going to talk about in a little bit more detail in a moment. But I think, first of all, we're going to go a step backwards and talk a little bit about ET Captial.
You've got a long history in Cambridge and ET Captial is well established. Can you give us a flavour of the history and the context and talk about how the funds have been developed over time and maybe some of the success stories in the portfolio?
I'm an entrepreneur manqué, James. I always wanted to be an entrepreneur. After business school, I joined 3i, which was a venture capital firm, big at the time, 15 regional offices, 750 people, a dominant player in UK venture capital in the 80s. And they had an office in Cambridge, which was focused on startups. And they sent me here. And I arrived on the Science Park in 1986, did a number of deals, spent just over 2 years at 3i, and then went off to start my own business. And while I was starting my own business, along came, through a series of connections, Midland Bank saying, we want to set up a series of regional funds. And would you be interested, ET Captial in its precursor form, which was Egan and Talbot, would you like to manage one of these funds, the one for East Anglia? And we said, why not? So we actually opened the first fund for business in 1993, which was the HSBC, as it was then, had become, because Midland got bought by HSBC, Enterprise Fund for East Anglia and the home counties. And that's the first of 9 funds that ET Captial has managed since then, the most recent of which are 3 funds which we've done in partnership with Carbon 13.
Yeah, we actually interviewed Nikki on 109, episode 109. Has climate tech been a particular focus for the fund or happy coincidence? How does that work?
I think we see ourselves as broad technology investors, but the funds themselves may well have individual themes. So early on, it tended to be hard science, physics-based, computing, that sort of thing. We did some life science investing, mostly through a secondary called Krill Nominees. And then latterly, we've done 5 funds which have been low-carbon oriented, of which 3 have been in partnership with Carbon 13. And we did 2 other funds called Carbon Order as well.
And we know David well, David Gill. And you also have James Griffiths in the team, right?
We try to be an old-fashioned venture partnership where we've got 3 directors who are also the owners. We make decisions collectively, trying to leverage the power of each other's different perspectives. We like to think we're sufficiently neurodiverse that we've got complementary inputs to make sure that we're not doing anything too stupid. Between us, we cover all of the bases, doing the business that ET Captial does as a venture fund manager.
You've had some real successes with various companies IPOing, etc. So do you want to give the listeners a flavour?
We've had 3 particularly successful deals, 2 of which were life sciences, one of which got floated on the New York Stock Exchange with a capitalisation of $1.8 billion at peak, and another got bought by AstraZeneca for over $400 million. And then most recently, 2 years ago, Carbon Engineering, one of the low carbon investments we have, got bought by Occidental Petroleum for $1.1 billion in cash, which is always the way to get your deals bought out.
And does it vary by fund, or whereabouts do you come in? Is it the seed stage, Series A, Series B?
We're absolutely a seed investor. So we tend to invest between 50 and 500,000, with our sweet spot being in the sort of low hundreds. Yeah, we try to be in early with the very first other investors, most often with angel groups or other seed funds.
So, Martin, thank you for giving us that overview. And I think it just cements the next bit of the conversation, which is the credentials that you've got in terms of understanding the investment community and culture in Cambridge. So we've got you on today to talk about this new fund. Do you want to tell us a little bit, first of all, about what you're trying to achieve with this fund? And also what I'm interested in is, why hasn't it been done before?
I think that we, so when I say we, early stage venture investors, are quite determined to be magic makers. And by that, people who can select and identify superlative ideas and great management teams and bring them together and be the sort of wizard that brews the mix, makes it work. Unfortunately, I think the reality is that just like with the public markets, picking winners doesn't, by and large, is very hard to get right. And therefore, a diversified investment approach is more likely to succeed. People have found it hard to do that in a venture space because what do you diversify over? Do you do every deal that's created in Cambridge? You clearly can't do that because there are lots of businesses starting here which aren't high growth, which aren't based in technology, which probably don't have credible intellectual property or strong founders. So we decided that the thing to do was focus on a small number of deal originators, of whom the most important would be Cambridge Enterprise. But for the purposes of the original research, we looked at deals coming out of Deep Tech Labs, out of Stark Codon, out of O2H, because we know that they will be packaged in a reasonably sensible way. And we said, well, if you invest in every deal coming out of those deal originators, but follow a lead investor, you could actually deploy £100,000 at a time broadly across the Cambridge cluster. Because I think intuitively we all know that Cambridge is full of talent. We also know that businesses like Arm, now worth more than nearly twice what Intel is worth, have been outstanding successes. So surely we can follow an investment approach in Cambridge which actually not just exploits, but liberates all the talent and potential in the Cambridge tech community.
And this has been a data-driven exercise through the research that you referenced at the beginning of the conversation. So it sounds like then the answer is no, venture capitalists can't pick winners. And to use the analogy that you said you were encouraged not to, it's a tracker fund versus an actively managed fund, right?
Absolutely, James. That's 100% spot on. I don't want to accuse my fellow venture capitalists of being incompetent. There's quite a lot of luck in ensuring that if you're taking a subset of all the early stage deals originating in Cambridge, it's quite a lot of luck that your portfolio happens to coincide with the ones that do work. So if you can diversify across all of the businesses, then you are much more likely to intersect the ones that do work. Now, if you're putting a very small amount of money to work at the beginning in a seed round at a low valuation at that stage, then you will normally get a very strong return in the ultimate exit. Now, along the way, you will get diluted. Everybody gets diluted. Sometimes the dilution may be brutal. But the data shows, and going back to your original start of this question, we are following the data. The data shows that if you just invest in the seed round, then on balance, you will get the return.
So you mentioned again at the top of the conversation about the approach will produce, apart from a couple of year period, as the data showed, it will produce a greater return than FTSE. What else did it show? What other learnings did you get from doing the piece of work?
So I think that's a great question. Another one is that with a diversified approach, you'll get the returns. We know that. The limitation and the issue which anybody looking at this would have to bear in mind is that it takes time. Its liquidity is unpredictable. And when you've got a venture capital boom, when the cycle is upward, so in the period from 2015 to 2019, you get exits quite quickly. And the fund produced, the synthetic fund that we modelled on the base data that we sliced and diced, showed that investing following this strategy, you would have got more than twice your money back within 4.5 years first investing. In contrast, if you were investing in the period between 2020 and the first half of 2014, in the most recent cohort, then you'd have had no money back at all. There are some strong valuations on follow-on rounds of investment, so your portfolio looks quite good, but there's no liquidity. No deals have gone back to cash. So our sort of analysis is that in the good times, you might expect a fund to produce cash within 5 to 8 years, but in times where the venture capital aftermarket and the follow-on market, investment market is much weaker, you might have to wait 10 or even 15 years to realize the investment. So the time is a big factor in this.
And just a question about the mechanics of the fund again. So you're working with organisations like Cambridge Enterprise. Are you automatically investing in every deal that comes through, or is there still a kind of element of curation and picking and choosing?
That's a very good question, because we're a regulated fund manager, and therefore by definition we do have to stand behind the investments we make. So if there was something which is patently ridiculous, and I think the likelihood of that happening is very remote. Cambridge Enterprise have been around a long time and they know what they're doing. But if it were ridiculously overvalued or the management team had some fatal flaw in it, then we might pass on the occasional deal.
And I guess then by definition, you're investing in both life sciences as well as deep tech. You're broad across lots of different spectrums. Yeah.
It has to be science-based, because that's what Cambridge is about, isn't it? The application of science, that's where its strengths have come from.
So Martin, in terms of the actual fund, you look at the report that you produce, you look on the website, there's this overwhelming message there about democratising investment. What does that actually mean and who will benefit from it?
I think that everybody's aware of the fantastic role that Cambridge Angels have played in the cluster. They've funded and added value to and really contributed to the growth of many successful Cambridge startups. But the members of Cambridge, there is a limited number of people who are members of Cambridge Angels. They're individually wealthy people who can afford to put quite a lot of money to work in each deal. There are other business angel groups in the city, like Cambridge Capital Group. But again, the members of Cambridge Capital Group operate as a syndicate, so they've actually got to actively get involved in deal selection and making the decision to write a check, and on the basis of having done some due diligence and investigation and satisfying themselves about the deals that they're about to do. So all of these are time consuming and also require, and probably you're talking about, in the case of Cambridge Angels, tens of thousands of pounds per transaction, maybe more. And in the case of Cambridge Capital Group, certainly thousands of pounds per transaction, maybe more. Whereas there are lots and lots of people who I think feel that they've contributed to the growth of Cambridge in whatever way. But members of the university, people who work for service providers in the city, and they might like to feel that they could invest in the success of the Cambridge cluster and benefit from that. And so we want to try and push down the opportunity to participate in these high-growth, early-stage Cambridge businesses down to other people who could benefit from that and who contribute to the cluster. Clearly, we're not a retail fund manager, therefore we can't offer it as a retail product to anybody, and therefore the bottom layer is a definition of sophisticated or high net worth individual investor. But we can, I think, take it down and offer it to people who are reasonably prosperous but time poor, but would like to be investing in the cluster.
And do you think it might be a byproduct of it might also be that it's someone who's maybe exited quite early in the career, and therefore we're potentially building the next round of Cambridge Angels as well?
Absolutely. And I think there's no reason why people can't do both, which is both participate in individual deals through Cambridge Angels and Cambridge Capital Group, but also participate in the index fund so they get broad exposure to the cluster as well. So there's a sort of horizontal element in the index fund and a vertical element in them bringing their skills to bear to ensure the success of individual deals where perhaps they've got domain knowledge or expertise, which would be really valuable.
So a couple of questions then, just to unpack that in a little bit more detail. I guess the positioning of that and the narrative around it and the terminology is important, because do you think there's a bit of confusion potentially around this looking like a crowdfunding platform? Because that's not what you're describing. You're aggregating individual investors and combining that with institutional investment into the fund.
I think the difference, crowdfunding has got some of the characteristics, which is the ability of more people to invest in more deals in smaller amounts of money. But the big difference is that they haven't got the diversification across the portfolio. So even in crowdfunding, you're having to select what you put your money into. And therefore, by definition, you've got the risk that an active approach is going to cause you to miss the good deals. Whereas with a diversified index approach, you're into everything that the fund is investing.
And is there a kind of percentage of the fund that's coming from institutional investors versus the kind of individual investors? Have you got a kind of balance in mind?
So we're segmenting it into more than one fund. So in the first instance, we're raising an SEIS EIS fund, which is a tax-efficient individual investor fund. And we don't anticipate any institutional investors in that. Okay. Although we have had institutional investors in some of the SEIS funds that we've previously run. So it is possible. And then our intention is to raise a fund based on a limited partnership structure, which is tax transparent, therefore it's efficient for institutional investors later this year and into the first part of next, which would be a larger fund investing slightly later stage, but approaching the investment in the same way on a fully diversified across the cluster basis.
Okay, so we've talked about the investment fund in itself and who is likely to invest in it. I guess what I'd like to do now is talk a little bit about the deal originators, because this only works if you have the relationships with the Cambridge Enterprises, Deep Tech Labs, O2H and the other types of organisations that you've mentioned. So I think it's pretty clear you are intrinsically linked already into the Cambridge ecosystem. This is going to sound slightly strange, but what's in it for them? Is it just that there's another investor on the card?
At the moment, because we are in a period when capital is scarcer rather than more plentiful, then for anybody who is in the end trying to build businesses, having access to more capital, particularly where the investment decision making is predictable and consistent, is attractive. So it means that they can then bring more capital to bear on rounds. It means that other investors that they are close to, or indeed their own funds, can spread their capital more widely, but still get the firepower they want into the individual deals. So I think that's an important reason. And I think also that we're an experienced team who have played our part in supporting Cambridge-based businesses in the past. So we would play a constructive and positive role as investors in the future development of those companies as well. It's not just the basis of coming in, but also the way in which the investments would work post-investment, post-transaction completion.
You described how you're targeting people that typically wouldn't be able to participate in angel networks. So does that give you a bit of a burden of education to try to frame the kind of investment and the risk profile? And how are you going to go about marketing this to the general public, but your target audience?
I think that's absolutely right. We have got an education hill to climb, not least because venture capital has always been highly selective. For me, it's going back to my roots, because 3i was a massively generalist fund manager, which had exposure to the vast majority of a significant, sorry, not a vast majority, but a significant proportion of SMEs in the UK economy in the 70s and 80s. And it was able to do that by having well-structured transactions which to a greater or less extent looked after themselves. So we're rediscovering an investment tradition which existed in Britain and which has been slightly blindsided by the Silicon Valley approach of highly targeted value-adding investing. Now, that's got its place. Somebody's got to lead these deals. Yeah. We're not going to lead them. Somebody's got to lead them. So there is room, of course, a necessity for highly targeted active investors. But yes, I do think that you're quite right to say that we've got to use the data and use case studies around the data to show people how this investment approach would work in the future based on the past. And in this particular case, while I think there's a good argument for saying generally that past performance is no indication of future performance, that is a statement about selective fund management, the human factor. This is merely observing a system-wide investment approach and saying, is that likely to continue in the future? To which it seems to us that it will, because there's more businesses being built by more skilled deal originators in an ever richer and deeper cluster. Probably the only peril is, are people overpaying for deals? And at the moment, I think that's probably not the case, because if anything, there's downward pressure on prices because capital is relatively less available. And therefore, I think we are unlikely for the foreseeable future to be overpricing the deals that we go into, because, of course, it's the lead investor who's pricing the deal, not us.
So you talked about the average check size that the angel networks are writing. What kind of entry criteria, what kind of size of commitment would a less experienced investor that's getting involved as a first-time investor in this fund have to make?
I think it'd be right to say that in an angel network, you're probably not likely to write a cheque for less than £5,000 or £10,000 per deal. By definition, of course, we've set the minimum subscription to this fund as £10,000, but of course that's spread across 10 or 15 deals, which is what we anticipate doing in the year. So it's a factor of 10% of committed capital per deal, relative to what an angel investor would be investing on a per deal basis.
You have a target amount for the fund, so have you got to hit that total amount before the fund goes into play? Or
absolutely right. We've said that the minimum close will be £1 million in this first fund, and a target of up to 2 million. So we would like to get closer to 2 million than 1 million. And we think, because this is again looking at the historic data, that the credible deal originators in the cluster are producing about 10, 15, maybe 20, if you include other deal originators who are not in the original data set in the cluster. So, we could do 100,000 into 20 companies. Yeah. We've got costs of some costs. So if you look at the total capital, we're probably investing actually about 92% of the total capital into the companies, and the rest covers various costs. So that, as I say, that gives us, 18 deals, capacity to do 19 deals.
Okay. So for people listening to this and maybe are interested in participating, what's the process?
As I mentioned, James, earlier, that this fund is only for people who are sophisticated, categorised as sophisticated or high net worth individuals. And therefore, we have an onboarding process via the website, which people have to go through to demonstrate that they fall into one of those two categories. And if they do, we'll let them have a copy of the investment memorandum, which has got the application process in it and describes the full terms and conditions of the fund and the investment management agreement.
Okay.
So, Martin, I think it's a really interesting approach, and thank you for coming on to talk to us about it. You said earlier on it's like rediscovering an old way of investing, but actually it's not just that, it's the refreshing it, because you're offering something to the investors, you're offering another option for the startups and also the deal originators, and I think that's pretty unique. So I guess we'd like to wish you all the best in getting the funds off the ground. I know that they've only just launched, and where can people go to for more information?
So the website is live. There's a link on the homepage which enables people to start the process by demonstrating they're high net worth or sophisticated. If they do that, they'll receive an investment memorandum with the application process, and they have to apply by the 1st of July.
Today's show was produced by Joe Donaghy of Cambridge TV and supported by our media partner Business Weekly. The Cambridge Tech Podcast is available on all major podcast platforms and on cambridgetechpodcast.com. If you've enjoyed this podcast, please give it a 5-star review. It'll really help others discover the show.
If you are a startup looking to grow in Cambridge, the Bradfield Centre offers a range of flexible membership packages which put you in control of your office and home working mix. There's a vibrant, collaborative atmosphere, on-site cafe, plenty of green outside space, and regular member social events. For more information, visit bradfieldcentre.com or call 01223 919 600.